In the midst of a nerve-wracking presidential election and a global pandemic that's been ravaging economies everywhere, the US central bank has been trying to steady the ship. It's been cutting interest rates to near zero and is keeping them that way for the time being in order to help the US economy. The US has been absorbed by a bruising presidential battle, and Jerome Powell's decision to maintain interest rates at close to 0% is critical for whoever wins.
The current economic downturn is the most severe in our lifetimes. It will take a while to get back to the levels of economic activity and employment that prevailed at the beginning of this year. And it may take continued support from both monetary and fiscal policy to achieve that.
Cutting interest rates lowers the value of the dollar and makes it cheaper for consumers to spend, businesses to hire, and to invest. But there's always a flip side. A cheaper dollar is good for exports, but makes imports more expensive. And with Congress unable to agree on a new coronavirus stimulus program, there's growing concern that the Fed will run out of options to help an economy forecast to end 2020 with a steep contraction. And yet Powell appears undeterred.
Is monetary policy out of power or out of ammo? And the answer to that would be no. I don't think that. I think that we are strongly committed to using these powerful tools that we have to support the economy during this difficult time for as long as needed.
Even so, while Powell is committed to reducing income inequality, some experts think this era of ultra-low interest rates is actually increasing it by contributing to stock market rallies that disproportionately benefit the wealthy. Owen Fairclough, CGTN, Washington.